Welcome to Bullshift, the podcast. For the next half hour or so, we'll be exploring financial biases and the way the financial services industry shifts your attention to be more bullish. I'm John DeGuy, the author of the book Bullshift and the host of the podcast. My guest for the first episode is Prasad Ramani. Prasad is the CEO and the founder for a firm called Syntonic. And Syntonic is a firm that does weds technology to behavioral finance to help people make better financial decisions. He's an industry veteran. He's worked as the head of quant at a family office that manages $1.4 billion. He builds automated quantitative systems for people to help them make better decisions. And he's passionate about helping people marry the idea of financial decision making with their personal lives and using technology to do that. He's a well-respected and internationally acclaimed industry expert, and he's a regular speaker at the London Business School where he focuses on behavioral finance and decision science. Prasad, welcome, and thank you so much.
Thank you, John. It's so great to be here. It's fantastic. I mean, I think you're doing a great job with your books and your articles and with all the industry events that you speak at. So glad to be here with you today.
Thank you so much. So I want to begin by just talking about how we each got started in the industry and how we think about finance as being the sort of thing where we both, I think, started thinking about finance as being a quantitative thing where you look at numbers. And then there was a point where we sort of each had our own little aha moments where we realized maybe there's more to it than just numbers. Maybe there's some psychology, maybe there's some behavior involved. Could you maybe tell me about how you sort of had your first aha moment?
Yeah, no, absolutely. So I kind of like joke that I'm a failed quant because I've been a quant analyst for like 23, 24 plus years. And the whole idea behind quantitative finance, right, is to kind of like use numbers to make, hopefully optimal decisions. Mm-hmm. And what I learned very late into the game was making optimal decisions itself is probably a little bit of an over-optimism there because there's no real optimal decisions in real life, number one. Mm-hmm. And number two, there's so much of bullshit goes into your financial models, in your quant models, that it's really, really difficult to like say that my models are backed by good assumptions or not. I mean, it's really garbage in, garbage out. My big aha moment was when I was basically analyzing the performance of portfolio, the family office portfolio. We were doing really well with the strategic asset allocation part. Mm-hmm. But the tactical part, where we would basically place in trades and get in and get out, and we're all smart quants here trying to time the markets and stuff like that. I noticed that we were actually screwing it up pretty badly, and no amount of quantitative analysis could help me find the answer. So I kind of went into the whole old-fashioned way of like looking at things and just seeing what are we doing wrong in terms of our decision-making approach. And after going through like some 300 meeting minutes over a period of 2 weeks, I found that everything was psychological in nature. And that was a big aha moment for me.
I think one of the things that people say in finance is that a lot of people who work in finance have physics envy. And by that, what I mean is they think of finance as being the sort of thing where things can be quantified and it's empirical. But in fact, physics is a pure science, and economics and decision making is more of a social science where a lot of things are emotional, a lot of things are behavioral, and we don't like to acknowledge that. We always like to think that, we can put on our thinking caps, and as long as we think better or look at information more carefully, we'll come to a better decision. But in fact, that's seldom the case.
Absolutely, right? I mean, we all love structured solutions in life, right? I mean, we all want life to be a perfect equation where once we know the left-hand side, then somehow magically the right-hand side comes up and then everything falls beautifully into place, right? And I think mathematics, which is obviously a very beautiful subject, like you rightly said, physics is a beautiful subject. They're all real natural science. And there are laws that actually work very well. But when we try to take that beauty from the mathematical and the physics, and the science part and try to it's like fitting a round peg into a square hole or something, right? And they just try to bring that beauty and then try to almost like impose it on something that cannot be fundamentally quantified or fundamentally analyzed in a very rational manner, that's a problem, right?
It's fascinating listening to someone who's very quantitatively able, and you have a PhD, if I'm not mistaken, right?
No, no, but I don't have a PhD, but I work with a lot of PhDs, and I'm called the PhD whisperer in my team because I
Okay.
kind of get things done.
But at any rate, you're very able quantitatively, and people that are, there's a saying that if you're good with the hammer, everything looks like a nail. And part of what we do in the industry is that we think if we were good at analyzing things empirically, and so it's sort of like looking, you lose your keys in a parking lot, and then the old joke is, why are you looking in the north lot when you lost your keys in the south lot? And the answer is, well, because there's more light here. It's just easier to do what you know when there are things that make your job easier. But in fact, if you could actually stop and look at it, there might be other ways of looking at problems, thinking about situations that are not as obvious. And a lot of people that work in the finance industry, their head is down. They don't stop long enough to lift their gaze to see, well, what if we looked at this from a behavioral perspective? I wonder if we could explain the way our clients are reacting based on their emotion. If we just sort of say, well, if we look at this PE ratio, there's no reason why we should be worried because valuations are fine. So I'm wondering if your worldview has changed as a result of your having worked with Syntonic and what you're doing now. How has that changed the way you look at the world and the way you do your business compared to maybe the old days when you were more of a number cruncher?
No, look, this is a great question, right? Because going back to that aha moment, right? When I found that there's a lot of like psychological decision making biases that come into the picture. I'm a researcher at heart, right? So my first idea was to go to the academic world and try to see what research was there. Right. In terms of decision making science, and it just blew my mind to see that there's all this amazing research in behavioral psychology and behavioral economics, but nobody was kind of productizing it and nobody was really talking much about it, right? Mm-hmm. And so previously, as a quant, I used to think of things as very distinct models, that kind of like fit in perfectly. So for example, I would be super focused on, if I were to do like a black Litterman model for asset allocation, right? I'd be super focused on, what kind of historical time period am I using? How the asset correlation structure is working. Right. Is it stationary, non-stationary, normal distribution, fat tails, all this stuff, right? But the essential thing that I was missing was we actually transfer our biases into our models, right? So for example, if you are bullish by nature, right? And for example, if you're optimistic by nature, and our industry sort of demands that, in a way, right? I mean, you can't be really the bearer of bad news. Right. Now you actually push this bullish and optimistic views onto your model, in the form of assumptions that really are just reflecting what you wanted to say, it should say. So to just give you another example, right? If you take a look at portfolio optimization, right? The more the number of constraints you place on your optimization model, the worse it's going to perform. Because you're literally now telling it exactly what to do, but you're not saying it. You're just pushing it in the form of constraints. And so similarly, in a lot of our models, we kind of push our assumptions, which are our biases, and then say, wow, the model says this, and the model has been back tested, and the model works great, and and now suddenly you feel that you've got something that's beautiful, that's well researched, that's scientific, and that can be data backed, right? But what you miss is your biases have gone from you to the model. Like, do you see what I mean there?
Yeah. It's a transference, and I think the idea, the thing that a lot of people have to come to terms with, and this is true in all industries and all walks of life, but especially in the finance industry, is that every single person on the planet is biased. And if you think about it, probably the most famous name in the field of behavioral economics is Daniel Kahneman, who originally won the Nobel in 2002 and wrote a book called Thinking Fast and Slow. Kahneman says that he's biased. And if the person who studies bias and is more aware of bias than anyone else will acknowledge his own bias. I think it's safe to say that you are, and that I am, and that everyone listening today is. And I think a lot of what you have to do is come to terms with your own biases.
Exactly, and it's part of our evolutionary psychology, right? I mean, for example, anchoring, and this is where you get fixated on a particular data point or a particular experience or whatever, right? Now, if you look at our whole, evolutionary psychology, we as people, right? We as people, we are hardwired to hate uncertainty. Nobody likes to be in an uncertain situation. If you're out there hunting, 500 years ago or 1,000 years ago, you want to be sure that you're doing the right things, and then you want to be sure that you get back home, right? Now imagine like somebody would tell you, well, you get out of your cave this morning, but we don't know if you'll come back or not, right? So nobody likes uncertainty, and that's kind of gotten distilled into our thinking process. It's kind of like got baked into our thinking process,
Right.
and because we hate uncertainty, we just want to latch on to anything that sort of makes sense. And so this is a pretty insidious bias. I mean, anchoring, right? It's not easy. Now, if you are a little aware, then hopefully you can be a little more safer than somebody else.
Right. Well, the example that I like to use with anchoring is if the market drops. If you get a statement from your portfolio for year end and you're at a nice high level, you've got $700,000 in your portfolio, and then the market drops, and you might have online access, you might get a chance to look at your statements. You might have to wait until you get your next quarterly statement, in the spring. But at any rate, the number is, you're down to $635,000. You're down by, almost 10%, and it's frightening. The problem is you're anchored on the $700,000. You had $700,000, and so you feel the pain of a loss because you once had that. It was there. It was, you could see it. It was on your statement. It was real. And so now that it's no longer there, it's like, wait a minute, I'm supposed to only go up. And that brings into question things like prospect theory and all manner of other things. I wanted to talk to you a bit more about optimism. I know one of the things I talk about a great deal in Bullshift is optimism bias. It's probably the one thing that it's funny because optimism is seen as being the best bias. Many people say it's great. Kahneman himself has said that if he could have a magic wand and he could give anybody anything as a newborn child, it would be to be optimistic and joyful, because there's a lot of research that shows that optimism correlates positively to having a successful life and a successful outlook on life.
Absolutely, absolutely. Look, I am all for optimism, right?
Right.
Right. I'm all for optimism.
Right.
The place where I differ is there's a very thin line between optimism and optimism bias,
Right.
or also what we call as over optimism, right? So they kind of like make it a little simpler, right? I mean, it's again the same thing between confidence and overconfidence. It's great to be confident. You got to be confident, but overconfidence can kind of like take you to a place where probably it's not great to be there. But having said that, right, every single behavioral bias or every single behavioral trait that we have researched, we have found that there's a positive aspect to it and there's kind of a negative aspect to it. So I wouldn't go so far to say that, oh, this is a problem, right? Mm-hmm. There's something great about optimism, but there's also a problem about optimism, and any balanced, sane person should appreciate both those things, right? While it's great to have optimism, the issue that I find, especially with over optimism, is research has shown that it can lead you to procrastinate when you shouldn't be. It can lead you to make excessive, large, aggressive bets that are not the right thing to do. It can basically even make you kick the can down the road in terms of, like, say, for example, taking insurance or taking a disciplined approach to investing, or to even meeting with a financial advisor, for example. So it's very pervasive because obviously there's a very positive connotation to optimism. And it's a little difficult to tell people that, hey, look, you're overly optimistic. You're viewing the world with rose-tinted glasses, and that could be a problem. For example, if you go into asset allocation or portfolio management, and then you are assuming that equity markets are going to do like 14% or 15% in the next, like, say, 10 years or 12 years, that could really screw up your investment plan, right? So what I found at Syntonic is it's very important, for the advisors to be aware that they themselves are optimistic, number one. And I'm not saying that they're just doing it for the sake of business, or they're doing it because because they want to like mislead their clients or anything like that. We just we just can't see our own biases. I mean, as you probably know, you need a third party, or you need a tool, you need somebody else to kind of like hold up the mirror
Yeah.
and kind of show you that, hey, look, these are things you need to watch out for.
Ironically, research shows that people are better at identifying biases in other people than they are in identifying their own. Because when you see it, you recognize it if it's in someone else, but we can't see our own biases. We're too close to it.
Absolutely, I mean, that's exactly what I tell people, right? I could like come up with the perfect solution for your problem, John, if you have any problem, right? But if I have the same problem, I just won't be able to figure it out. And that's because I'm just so close to myself, right? Which is why I actually tell people that no matter how smart they are, or no matter how financially savvy they are, they need to have a financial advisor, because they need a third party professional who's got them that space between you and your decisions, right? And who can help you navigate that.
I wanted to talk to you a little bit about bias as we head into the end of 2022. Markets have been up and down this year. They were way up in the end of 2020 and way up in 2021. But 2022 has been sort of like two steps down and then one step back up, and then two steps down and then one step back up. And we've had, I think, what might be called a bull market, a bear market with a number of sort of bull market blips, sort of bull runs where things sort of move up a bit. But those are rallies. The bull market rally is in the part of a larger secular bear. And I wonder what you think about the optimism that people are showing. And I'm not really talking about advisors, I'm talking about ordinary investors. When they watch this happening throughout most of 2022, and especially in the context of what we've heard central bankers say, because we've had Tiff Macklem and Jay Powell say, look, there's pain coming. So we've been told there's pain coming, and yet people are sort of whistling past the graveyard and they're smiling and they're nothing to see here, and it's rose-colored glasses. And I wonder what you think about that.
I think that the great thing about markets, especially this year with all the volatility and stuff, I think this is directly related to another bias, which is confirmation bias. We all tend to read into news, or we all tend to like consume information based on whatever hypothesis we have already built. That's reality. So, for example, if I'm a very aggressive investor, right, and I've already made up my mind, and I don't know this consciously, but subconsciously, non-consciously, I've made up my mind in some way, thinking that this is a great opportunity. It's a little volatile, but it's a great opportunity, right? Now I start consuming information based on that, with that particular frame. And once I have that particular frame, it just doesn't matter, what other information you bring to me. I'll just consume it with that particular frame. So I'll only pick things that match my worldview, right? So if there are people, for example, I mean, I know people who are like really optimistic. They think that they can time the markets. They think that they can get on at the right time and exit at the right time, and like things like that. And then there are people, who are very conservative, who are like, always on the sidelines. They could be sitting in front of the greatest bull rally of their lives with lowest valuations ever, but they will not get in because they will have some information that will tell them that it's not the right time to get in, right? So it's very individualistic, and then which is where, again, I think this whole business of financial planning has to cater to the individual in terms of trying to not only understand who they are, but also to help them understand who they are. Because oftentimes we just don't know. And so no matter whether it's 22 or 23, 24, 25, this is always going to be the case. That's my view.
What was it? I think it was it the Greeks or the Romans that used to have a sort of sign above the cities as you entered, you know thyself. I think that one of the problems is that, people don't even recognize their own biases, and that's a real challenge because it's difficult to solve a problem if you cannot, or for whatever reason will not, recognize that there's a problem. There's nothing to see here.
Exactly, and I think that's where, as an industry, I feel we should do better. And we should basically look. I think the honest answer to a lot of questions in financial markets is I don't know.
Right.
I don't know how 2023 is going to be. I don't know how 24 is going to be. I don't know what's going to happen in 5 years, in 10 years, no idea.
Right.
But what I know is that if I follow a particular process,
Mhm.
the probability of me hitting my goals is much higher than if I don't. That's so instead of trying to like focus on the outcome and focus on trying to like build rosy scenarios and say why things are great and stuff, I think we should all just focus on the process. I mean, I think that would probably, I don't know if you agree or what you
No,
think.
I do. In fact, that's a wonderful lead-in. I was going to ask you now about what you're doing at Syntonic and with the questionnaires that you have. So, for the people that are listening, what Prasad has done is that there's actually a questionnaire that you can get online. I'm happy if you want to go to my website at standup.today. I can get you the link and you can do it yourself. And you can see, because I've used this, I've done it for myself, I've done it for my spouse, and I've shown it to other people. And it's wonderful when you can go through the process of maybe 10 minutes worth of questions. They're funky questions, they're not finance questions. You don't have to be a math nerd. It's a question of trade-offs, it's a question of what do you prefer, why is that? And after you've completed the questionnaire, what you get is you get an output which says, these are your biases, these are your tendencies, this is your approach as an investor. And I think it's extremely helpful for people who are investing on their own or for people who are working with an advisor. Either way it works, because self-awareness is really important. So maybe if you could tell the people that are listening a bit more about the process and how it works.
Yeah, so what we did, John, is we actually we spent more than 4 to 5 years of research on trying to figure out, how people make decisions and why they make the decisions that they make, right? And so we identified about 140 to 150 different biases, errors, cognitive, emotional. Even the academic world talks about, all these different biases. But obviously, it's way too much, right? So we then focused on the foundational, what we call the foundational 2025 biases that directly impact your financial planning, your financial decision making. And from there, we went down to a further, base 7 different traits, which is what you're referring to.
Mm-hmm.
And so the idea is we actually use a bunch of these different traits. So for example, if you come to me, John, and tell me that you want help with behavioral risk profiling or a behavioral understanding of what your wealth attitudes are or your money attitudes are, the different different solutions we have, and what you're referring to is just one particular solution that we've built for financial advisors to not only help them understand their clients, but for the clients to understand themselves better. And as you rightly put it, there's a lot of science behind it. There's a lot of data-backed models behind it. But what it does is it tries to analyze how you think in your normal real life, and then how those biases get transferred to your financial decision-making context, right? Because a lot of things that we do, while they are context dependent, for example, I could behave a little differently when I'm in the office. I could behave a little differently when I'm at my home. I could behave differently when I'm with my friends, right? But there's something basic about Prasad, or there's something basic about John,
Mm-hmm.
that is constant across all these 3 different contexts. And so we have picked those constant traits and then try to like figure out, all right, so if this is how you think in your real normal day life, how does that get transferred to your financial decision making context, right? And so the idea is to get financial advisors and clients on the same page, because we actually tell that while know your client is obviously a very lofty and a very ideal goal for every advisor to kind of like go through, it's kind of become a very how should I put it, a very boring process, if I may say so, these days. There's a bunch of like standard forms that people have to sign. They have to just whatever for complaints purposes, and so I think what we're trying to do is we're trying to put in the whole human connection back into the financial advisor client conversation, because end of the day, that is what really matters.
Right.
And so by talking about these behaviors, you are now in a very safe environment where you acknowledge certain things that can mislead you, and it could also do a lot of good. I mean, like I said,
Yeah.
we cover both the positives and the negatives, and then have a very very natural conversation out of it. I mean,
Right.
you've used it with a couple of people, right? So what was your experience?
I've used it. It's a great way to sort of explore things. It's a great way to open conversations and to talk about how people can think about investing and how people can think about what it is that bugs them and what their fears are. And you sort of learn about yourself when you go through the process. So again, for the people that are listening, if you want to contact me at standup.today, I can send you a link and you can go through the process with yourself and or with a loved one, perhaps a partner or a spouse, and you can actually do a partnering sort of session so that you can actually get a sense to see how the way you look at things might be different from the way your spouse looks at things. And then that allows for a whole new conversation about, well, gee, honey, I thought we were going to retire at 65, and I didn't know that you wanted to work later, or I didn't know that you wanted to start traveling more while we were still working, or whatever. Those conversations can come out based on the attitudes that you have, and it's really wonderful in having a more meaningful, robust discussion about goals and the way you approach things.
Yeah, no, absolutely, yeah.
Great. Now we're running a little bit short on time, so I wanted to sort of ask you the thing that we have at the end of every show is the things that I'm talking about now, which is that's bullshit and shift happens. So for the people that are watching, that's bullshit is when I ask people that are the guests to offer some suggestion about something that they find off-putting about the financial services industry. What is it that could be done differently? What is it that could be done better? And it may have to do with optimism, but it may not. I'm wondering, Prasad, what is it that you think is bullshit in the financial services industry?
I think the biggest bullshit is information is not knowledge. There's a lot of information out there. There's a lot of models. There's a lot of data out there, but there's no point in hiding behind that. And I think you basically couch your biases, you hide your biases behind a whole wall of information, and that's probably not the right thing to do. So that's what I call bullshit.
So hiding behind biases and a lot of people that don't want to do it. Okay, so let's take that a bit further now. So it's all fine and well to talk about what a problem is. Wanted to know if you could then maybe suggest a way to solve it. So that brings us then to shift happens. If it were up to you, if you had a magic wand and you could do whatever you wanted to make things better, how would you deal with that problem?
The first thing I would do is I would basically up everybody's humility score from like whatever 510 to like 95. Stay humble. You could be really wrong, and when you're humble, that's when you get to know that you could be wrong and that you don't have the perfect solution. And the next step then is to go on a journey of self-awareness. Try to understand where are you going wrong. What's your thinking process? Are you naturally over-optimistic? Which is fine, but just recognize that and then ensure that that's not getting passed on without your own knowledge, to your clients or to your process or to your portfolio. So know yourself. I think that's where shift happens.
That's a really nice way of putting it, so thank you. I'm wondering, just before we go, I got one last question. I keep on thinking of new things even as I want to head off. I just can't resist. I'm wondering if you think there are any ethical issues that might be part and parcel with the way advice is being given right now, maybe people that are not giving enough consideration to behavioral economics and behavioral finance when they impart advice, when they give advice to retail investors.
Yeah, look, the only, big ethical issue that I sometimes worry about when even people use our tools, right, which is all to do with behavioral analysis. It's so easy for somebody who's, not very scrupulous to kind of like use our tool and then look at the behavioral analysis, and then you literally understand your client's mind now. You really know how they make decisions, and so it's easy to use that knowledge to kind of like almost get somebody to do something that you want. It's kind of like, but we try to avoid that by giving both the client and the advisor the same set of information. Right. So that way there's no information asymmetry. Right. But when it comes to behavioral economics and behavioral finance and behavioral principles, that's something I'm worried about, because if you look at the marketing industry, the advertisement industry, all the industry out there, all the tech industry out there, they have been using behavioral science in a pretty unethical manner, all this year. So my worry is if, hopefully behavioral finance and behavioral science should be used for the good and then not to just profit.
That's a great way to end. Prasad, thank you so much. It's been a real pleasure speaking with you today. You're just such a wealth of knowledge. I always feel that I have to sort of keep up to try to make sure that I can be worthy of speaking with you. I've really enjoyed it.
Thank you, John. Same here. I really enjoyed meeting you, even this time. So I hope to see you in person soon. And good luck with your with your book and with your podcast. And may all great things happen to you.
Thank you so much. All the best. Take care.
Cheers. Take it easy. Bye-bye.
Bullshift, the podcast, was created in support of John DeGui's book, Bullshift, available now online and in bookstores everywhere. The comments and opinions are those of the author and his guests. They are for informational purposes and should not be construed as investment advice. John DeGui is an author, public speaker, senior investment advisor, and portfolio manager at Wellington Altus Private Wealth. For more information about John and his books, please visit standup.today. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.